Good evening, everyone. My name is Phil from Pragmatic Trading, and it's really nice to be here with you. This might be my first video, so first I have to say sorry in advance for my awful accent. I'm a non-native speaker, but I am doing my best to be as clear as possible. So, why am I making the first video right now? Well, there's something interesting that's going to happen in 5 minutes. In 5 minutes we will have the FOMC federal funds rate. You can see that here on this website, forexfactory.com. So we'll see in 4 minutes and 38 seconds. We'll see if the Fed will raise the rates or not. And 30 minutes later we will have the press conference, which might be even more important for the price action and for the outcome of this madness. So people will tell you not to trade the news. I agree with them, but I disagree in one point. You should trade the news if you have a setup ready. So as you can see, this is of course Coinbase spot pair, so I'm not trading here. This is just a visual representation of the trade I would take, or the trade that I would have taken before. I have no time to show you how I've got this entry here, okay? So I'll focus on other things. This is the 4-hour chart. These are trend lines. The yellow trend line is the daily trend line. I drew it using the candle bodies, and the orange one is the 4-hour trend line, and as you can see clearly here and here, I drew it using the candle bodies. I do not use wicks. Yes, an asset will react to the trend lines that were drawn by using the wicks, but I stick to the candle bodies because I was taught like that. So what do we see here? We see a false breakout dip, and now what are we doing? We are sitting in between those two trend lines. Why am I in a short? Well, usually the first initial contact with a very important macro zone like this one, never mind if it is a simple trend line, produces a strong move. This white line is one of the EMAs. I cannot say which one, unfortunately, even though I would like to share that with you, but it is one of my experiments and I wouldn't like to get in front of myself. So we have the federal funds rate in 2.5 minutes. What will happen? Well, do you see these two white rectangles? I've analyzed this range here, and I realized that these two zones could be the zones that reject the price strongly. How am I so convinced that price will go up during the FOMC? Well, you know that the backtesting or backtracking is one of the traders' biggest friends, right? You can backtest literally anything. You can backtest your strategy, and you can backtest what had happened during the FOMC last month, the month before, etc. What happens before, after the CPI, etc. So, market is always, especially the retail traders, they look forward to seeing the price go up. So, market is always positive pre-CPI and pre-FOMC, before the CPI and before this FOMC. So this is why we have this, I wouldn't say this is a support line, but we have this ascending triangle, right? So the intention of the market is more than clear, right? It wants to go up. So if it wants to go up, your next thought should be where it can go up and where will it be difficult for the market or for an asset to break through, right? To break out, whatever. So I've chosen these two zones. I remain in my short, which is here, you can see. And these two zones are interesting because if I was not in this short here, I would place my limit orders here and here with a stop loss somewhere here and the second stop loss a little bit above. I will explain why. I've used fib retracement and fib extension tools to get these zones. I realize these zones could be worth a risk, so no one knows what will happen, but something will happen in 15 seconds. Let's switch to the 5-minute chart. Let's watch the madness and let's watch the gamblers getting slaughtered all across the board. So we have 5 more seconds. Let's go. Will it go up? Will it go down? It goes down first and the madness can begin. Nothing happens. Alrighty, this is strange. I've never seen this during the FOMC. It goes up. Oh, no wonder. It goes up. The market wants to go up. Let's see what are the rates pending. Okay. I hope you are well prepared for this event because this might be one of the most important FOMCs this year. It seems like they have raised the rates. No, they haven't done anything, so gamblers will gamble inside of this range. Sometimes you get what you want, sometimes you don't, right? So I've had these two zones, they're still relevant, but if we keep dropping, I am more than happy because I am already in a short. And I've doubled down on my position. My initial entrance was on this wick, or this one here. And I exited that short and doubled down on my position here. I will explain why in a moment. Let me just see what will happen here. Alrighty, so let's go back to the 4-hour chart. If you want to learn how to trade, you must learn the basics. You should not listen to people who say things like, "Oh, trend lines don't work, they're too basic, the retail traders use them, don't use the RSI, everyone knows what's the RSI." Well, only fools can do that in my opinion. Why? Let's open the line chart. What do you see here in price action? We see a high and a higher high. What do we see in the RSI? We see a high and a lower high. What is that? That's a regular bearish divergence, okay? And it's the 4-hour bearish divergence. Okay, what caused this bounce then? Let's switch back to the 1-hour chart. Okay, let's go there. 1-hour chart, what do we see? We see lower low, higher low. Is that a regular bullish divergence? Did we bounce from 25,000 to 27.4? Yes, we did. So next time if they tell you that divergences do not work, tell them they are blatantly wrong. Let's go back to the 4-hour chart. Let's see what happens here. Nothing significant, so everyone is waiting for the press conference. I can wait for it too, but I'm not sure if I will make another video for it. I just wanted to show you what happens during the FOMC. So basically, if we go back to the 1-minute chart, you can see that the madness starts exactly at 8 p.m. when the federal funds rates are published. Why does that happen? Well, people are gambling more than they are trading, and people enter longs and shorts here. So people who entered longs got liquidated. When people saw this drop, they entered their shorts, and now they are getting liquidated. And if you ask me, it's totally well deserved. Well deserved. Why? Because if you want to trade the news, you don't trade when the news happen. You trade before the news happen, and you do it carefully. You find the confluence, you place your limit orders, or you place your market orders, whatever your style is, and then you trade it. This is how I traded this short. I saw the 4-hour bearish divergence, or the possibility of it happening, if I entered the short. Did I get the initial drop? Yes. Is my position secured? Yes, it is. Yes, I can hedge myself. Maybe I should do that to hedge my short position. But I am fairly convinced we will go down and liquidate all of these longs that haven't been closed right here. You see? This one here. So, why am I thinking that? Well, there are various reasons for that. One of them is the first initial touch with these trend lines. The other reason is that we have a strong fib confluence here in the zone. It is the first initial touch. Plus, market is always looking forward to seeing the market going up. The traders are looking forward to seeing market going up. We can see the increase in volume here in the first false breakout. We can see the increase in volume here in the second false breakout. What does that tell me? Well, we have a strong regular bearish divergence being formed in the middle of a strong resistance. What my experience tells me is that usually price can reverse at that point on the chart. Will it reverse? No one knows. If they tell you they know, they for sure do not know. So let's see what happens. We have 25 more minutes. I'm not sure if I should stay in this video or make a new one. I think I'll make a new one, take a break, drink some coffee and have some rest. These zones remain valid. Now when I turn my fibs on, you will probably be unpleasantly surprised because it will look messy, but when you look at professionals doing something, it looks easy at one point, and then when you try to do that, it looks complicated. So if I turn them on, and I will do that, I will go to the 30 minutes chart. If I do that, it will look messy, and I agree with you, it does look messy, okay? It does look messy, but I know what every zone presents, okay? So why have I chosen these zones? Well, this zone here, 27.368, is where I see three strong fib levels at the same place, right? Let me show you. I'll use the brush. So we have 78.6%, we have 170.6%, and we have 200%. So what are those? This is a fib retracement of the whole range, of this whole range, this top and this low here. We have this extension. Let me see, what is that? That's the latest move down, scalp pull, and we have 200% of this wave here, right? So those zones are the most interesting ones. In case price doesn't have, in case this asset, Bitcoin, doesn't have strength to go there, I think it could go to the 70.6%, which is fairly at the same place where 170.6% of this fib extension is, and 83.2% of this smaller fib retracement. So these zones are interesting, and this is how I've got these zones. So I can turn all of these off now, and I can enjoy the show. Why can I enjoy the show while everyone is being liquidated? Well, because I'm not a gambler, and I will never be. I was a gambler, just like everyone else who thinks they're the best when they start trading. And then you get humbled once, twice, 3 times, 5 times, 10 times until you learn your effing lesson, right? I think I can turn off this track. It's going on loop for 15 minutes now. And what do we have? Well, we have typical liquidations above and below. Price is still in between these trend lines, and to be honest, I doubt price will go up above this trend line or below the trend line before the conference, right? So we'll see. An asset moves where the liquidity is. Currently the liquidity was here and here. I can bet many people were liquidated in the past 10, 15, 20 minutes. And I can bet even more people will be liquidated when the press conference starts. So there you have it. This is why, and this is how I'm so confident in my short, and this is why I'm so confident in these zones here. So if you ask me, this 4-hour bearish divergence will play out sooner or later. It's very clean. It is there. It is in the middle of resistance. It is in this EMA, which is one of the most important ones. And that's what my experience tells me. Okay, yes, you should be prepared for every outcome. That's why you have the stop loss. You should have the stop loss. Maybe I can put it here at break even, but that's not something that I do because I don't want to get wigged out and then price can reverse back and go down. So we'll see. The time will tell if I was wrong or I was right. I'm sticking to my experience. I'm sticking to my knowledge. And if the 1 hour bullish divergence, regular bullish divergence, can do this, imagine what can the 4 hour regular bearish divergence do in the middle of a bear market. So what is my target for this short? Well, my name is Pragmatic Trading and I like to keep things pragmatic as much as possible. Of course, I'm not perfect. No one's perfect. We all make mistakes. The only difference is that some people learn from their mistakes and some people are stubborn and they will always think they're the best while they're actually the worst. So what is this? This is a macro pitchfork. If I open the daily chart, you will see that we've got this pitchfork on 21st of November 2022. That's more than 8 or 9 months ago, right? More than 10 months ago. So this is a macro pitchfork. It's really big. You can see it was respected fairly enough, both on log and on non-log chart. You can see this touch here, which is beautiful, 78.6% of the pitchfork. And you can see this one here, these rejections. Beautiful, right? So where is my target? Well, it's around 23.4 on the non-log chart. If I turn on the log chart, it could be lower. 21.8 in case we reject here and go down slowly. So the wisest thing would be to exit at the 23.456. Why? Well, I've doubled down on my short position and there's no need to risk for another 1500 or 2000 move. I can fairly take a lot of profit here. I can exit my trade and enjoy the show. Maybe prepare for the longs, right? So this is where my target is. Why there? Well, I'll cover that in one of the upcoming videos. There will be many videos in the future. I'm starting my trading communities. I am keeping things serious, pragmatic. I want to share my knowledge and I want to help other people navigate the markets and be the best versions of themselves on the market. And sometimes this is where my non-native English skills come to power in the market and outside of the market. That's what I wanted to say. So why bottom of the pitchfork? Well, that's where price usually reverses. Yes, sometimes price can lose the bottom of the pitchfork or top of the pitchfork, confirm it as resistance or as support, and keep going in the same direction. But that's not something that happens on the first or initial touch. The same with trend lines, the same with fib levels, etc. It's what my experience tells me. If you know better than me, well, I am happy for you and I will gladly listen to you if you can prove that I am wrong. Being a trader is not about being the smartest, it's about learning how stupid you are when you are stupid and being better each day. No matter how much does it cost, it shouldn't cost you much. It should cost you time. Time is the most valuable resource. If you want to start trading, you will lose money. There is no other way. So if you think you can start trading and if you start asking questions like how much do I need to invest to earn money, etc., nah, that's a wrong question and that's not how you start, because no matter how much you invest, no matter how lucky you are at the beginning, you will lose that money and you will keep losing money until you gain certain knowledge. It is how it is. You can get mad at me, you can say I'm wrong, you can say I'm a fool. I really don't care. So people, I'm here for you to share my knowledge, to share my experience. This is all I wanted to say for this video. We have the press conference in 15 minutes. Yep, 15 minutes. So I'll go and probably drink some water, make another coffee, roll a cigarette, and I will see you in 15 minutes, okay? I'll see you in 15 minutes. Guys, stay well, stay pragmatic, and be good. Welcome back. We have 3.5 minutes to the press conference, and now you're probably wondering, as am I, as I am, whatever, should we listen to this beautiful music and to the wonderful voice of Jerome Powell? What does he have to say? What will he say? How will it influence the market, etc.? Some of you might probably know that we have these algorithms which literally trade based on Jerome's words. So my conviction is that the fundamentals, what he says, whatever he says, it's just a fuel. So market is like a car. It will move in one direction. It can go sideways, yes, but eventually it will choose its own direction, and what fuels the car are the fundamentals. So technicals are the places where price can continue or reverse, but the fundamentals are what gives the price the fuel. So I know that probably many of you would like me to listen to Jerome with you, to talk about what he talks, but I firmly believe that the things he is saying, or the things that he will be saying very soon, are more important for the long-term trades and long-term investments. Now, there might be some of you who invest long-term, but I have to say sorry to you because I will not be focusing on what he says. Instead, I will be focusing on technical levels that I've shown you in my previous video, and I will be focusing on what happens while he speaks. So I will probably turn this off in 2 minutes when he starts talking, because I know pretty well that he will avoid direct questions. He will always try to stay objective. He will try to conform? Yeah? Or confront the journalist by saying everything's fine, everything's alright, even though nothing's alright. So the press conference will start in 40 seconds. Instead of listening to him, we will turn this off, pause it, and we will play the same old song. Welcome to the techno world. Now, I've shown you the levels above. I've shown you how did I get these levels. I've shown you why did I enter and double down on my short here, and why do I believe we will keep going down eventually. If not today, tomorrow, if not tomorrow, day after tomorrow, etc. because of the divergence inside of the high time frame resistance. Now, let's see what's gonna happen. The conference has just started. And let's enjoy this gambling show. Let's see, 1 minute chart. What will he say? Who cares? He will just give the fuel for the price to go up and down. So let's see what happens. This is the daily chart. I've shown you my targets. Let's go back to the 1 hour chart here. You can see that on the non-log chart we are above the trend lines. On log chart we are inside or in between the 4 hour and the daily trend lines. You can literally you can literally look at the price and assume what is he saying. Is he saying good or bad things for the market and its movement? Now, I forgot to mention, do you see these two blue lines? They are the pitchfork levels, and you can see these were the latest support before the latest move up towards the 31.8 level. Now, we lost that level, we reclaimed it, we went above it for a day and a half, then we lost it again. Now we are inside of that level. Okay, we are inside of that level. So why is this important? Well, this level is fairly important for the price, right? Why is that? Well, it will tell us if this is a bearish retest or we will reclaim this level and keep going up, probably towards the median line, the second most important level on the chart. It hasn't been retested as resistance because we lost it here, so we'll see. Right, let's go back to the 1 minute chart. What happens? Oh, price is going up. Long with everything you have. Along with everything you have, 100 leverage, and keep longing, my boys, keep longing. So he's saying something now. It's been only 2 minutes. I'm not sure if they started with the questions. We can check that. I cannot listen to him for very long because I'll get brain damage. I just want to see what he's saying. Okay, let me
GDP has come in above expectations. Recent readings on consumer spending have been particularly robust.
Robust.
Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth.
GDP growth. We're not in a recession. Everything is just a dream within a dream. Show a fancy chart and everything will be fine.
0.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance.
Better balance.
Over the
Let's
past
pump
3
this
months,
up,
payroll
boys.
job
Let's
gains
pump
averaged
this up.
150,000
Trade the
jobs per month,
news.
a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation.
That's why we had
the median
bigger inflation this month. That's exactly.
Employment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%.
Oh, really? No Sherlock. Come on.
2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026.
This is why we will have the choppy market, because at first they said the inflation is transitory, everything's fine, and now when everything's not fine, they are saying everything's fine again. Will you trust them again? Well, if you're a useful fool, keep trusting them and be the liquidity instead of extracting liquidity from the market.
Housing and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
He's parroting the same stuff again and again.
As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation.
Okay.
In addition,
come on.
The economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time.
Good luck with that.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
So choppy markets.
Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook.
So basically, he says that we have a plan, but if nothing goes by the plan, we will assess and we will reassess and we will change the plan. So he has been saying this for the past year and a half, and they've been wrong. They've been wrong many times. Is that on purpose, or is that simply misjudgment or stupidity? I don't know. I don't believe they're stupid. I believe they're highly intelligent. They have an agenda, and they don't work for the middle class. So they will do whatever they want to do. Your job is to adjust your trading style, to adjust your investing style, to be prepared for every outcome, because everyone expecting 100k Bitcoin, everyone expecting 10k Bitcoin. What if we have the choppy market between, let's say, 15k and 45k in the next 2, 3, 4, maybe 5 years? What if that happened? Are you prepared for that scenario? Are you? I mean, no one's talking about that in my experience. Everyone has one-sided opinions. Price will go significantly up or price will go significantly down. This is a bear market until proven otherwise. If you want to be pragmatic, if you want to be objective, you have to say that, because that's the reality we are currently in. If this is not a bear market, then please tell me, what is it? Yes, we can zoom out in the past 5, 6, 10 years. It is a bull market, a constant bull market. But if you only look at that, you will get chopped out and you will lose all of your money. If you stay pragmatic, you will realize that this is a bear market within a bull market. Okay? And that's how you should define this one. I mean, you can define this one, and you will define this one however you want to. I'm not here to tell you how to define things. I'm here to tell you what I see, what I feel, and how will I navigate these markets. Okay? So I always try to be as pragmatic as possible. Let's go back to Jerome. Price is dipping a little bit. I didn't expect that. I expected my level to be at least kissed. We have missed it for barely. Let me see. $3.05, $7. Not bad, right? Not bad.
See that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restricted.
It's always
You're
an
not
open
saying
question.
today that we've reached this level.
It's always an open
We're not
question.
saying, no, clearly we are just, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target. Okay.
That's true.
And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to
More
Rachel.
questions, please.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you
You're
characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Oh my God.
Yeah. So the proposal at the meeting was to maintain our current policy stance, and I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some. You saw, I think, 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were
25.
arguing over that. People just stating their positions. And really, what people are saying is, let's see how the data come in. We want to see. What we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months. We want to see that it's more than just 3 months, right? We want to see, the labor market report that we received.
Sometimes what you want is not something that you get.
Want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks.
So you can delay the process until you realize the shit has hit the fan. Okay?
Or hike at the end of the year due to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time.
It's not going to happen soon.
That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another half a point of the funds rate on it? Does it tell you that, does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't.
Of course, you're always lagging.
The model.
You're always lagging, my dear Jerome. You're always lagging.
And that the economy reacts, and again, that's another reason why
He doesn't want to crash the stock market. He doesn't want his precious big pharma and other companies to crash, to lose their asset value. So that's why they're always lagging. That's why they're always going with the flow. I mean, I understand you have to go with the flow. You have to assess the data and then act on it. But at the same time, you have to do something in advance, because if you don't do that, the data will go on its own way and you will always be lagging. Okay, you will always be lagging. So let's see what does he have to say.
expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places.
What about the Phillips curve?
And in the jobs worker gap, you're also seeing supply side things. So that's happening. I would say though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from
That's called stagflation, my dear friend.
soft landing to something different. Would you call the soft landing now a baseline expectation?
No.
Say yes.
No,
Oh, fuck.
I would not do that. I would just say, what would I say about that?
Don't risk it.
I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible.
Oh, really?
And I also think this is why we're in a position to move carefully again. That We will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates.
Why not? Because he doesn't want to crash the stock market, because that will hurt the big money.
Of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that.
So basically you have 3 or 4 months of inflation staying at the same level or going down a little bit, and he's saying that those are the effects of what they have done. Well, it might be, but at the same time it might not be, because the inflation has rebounded once. Why couldn't it rebound again? Did it rise in this previous month? In this month of September? Yes, it did. So, what?
Another set of questions. For now, the question is trying to find that level
Good luck.
where we think we can stay there, and we haven't gotten to a point.
Of course, you haven't gotten to a point where you can be confident with saying it will rebound.
Confidence
or
about
not.
that yet. That's the stage
This year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last 2 meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina?
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And there's so much uncertainty around that. When we, in the moment, we'll do.
So I'm gonna stop here. Why am I going to stop here? Because I've been listening to him for too long, and I can fairly say that he has said everything and he has said nothing. Okay, why am I saying that? Well, you can see how he's orbiting around the questions, giving the most objective answer. We will always assess the data, we will always lag a little bit, we will always do this if that happens, we will always do that if this happens, etc. So basically you shouldn't care about what he's saying. Yes, you can and you should listen to him if you want to get a grip of their plan, but basically he repeats the same agenda every single time in every press conference every month. Okay? They always say they will assess the data, they will go with the flow, they will raise the rates if inflation doesn't go down, they will cut the rates if the inflation stops rebounding and if it goes lower. So that's something you know too. Now let's get back to the charts. Okay? So I told you before, if you want to trade a news, the best way to trade a news is before or after the news happen, right? After or before they arrive. I've done that by entering my short here because of clear technical confluence and reasons, and I'm comfortably sitting and making fun of Jerome and everything he says. Why? Because I want to have fun, I feel comfortable, my position is in profit. I repeat, this is just a visual representation of my trade because this is the spot pair. Why am I charting this one? Well, several reasons. First, it has enough data. Bitstamp, the exchange, has more data, but Coinbase has enough data for me to chart it. Of course, I have other charts on perpetual futures, etc., on other exchanges, but I am not going to show them to you now in this video. So let's go back to small time frames and let's see what had happened before the news. So if you ask me, the best way, the best place and best time to enter the short was here, here, and here. That's fairly obvious, right? Those are the peaks of this range. The best places to enter the long were here initially, and if you were late, if your limits haven't been triggered, you could enter along here, here, or somewhere here. Now, why am I saying that? Well, I told you in the previous video, market or the retail traders or the majority of traders are looking forward to positive news. And you can backtest almost every FOMC meeting and CPI price, let's say 12 to 10 hours before the news go out. Price always and always and always goes up because it's looking forward to positive news, to possible and plausible positive news. So if you have entered long, maybe the wisest move was to take profits here, at least partially, and let the rest ride. If you enter the short here, maybe the wisest move was to take some profits here if you believe the price can and will go up. I don't believe that's gonna happen. Even if it goes up, I believe it will be a wick where all of these people will add to their longs, they will buy more, and people who were late with entering here, they will open their positions up here because that's the mentality of a retail trader. I'm gonna delete these lines, we really don't need them. I just drew them for fun to see what's gonna happen. So I marked these wicked lows and highs, and I believe these lows will be taken sooner or later. Now, what had happened before the news? Market was looking forward. You can see the time. Okay, I'll put a vertical line to show you the news. So we have 8 p.m. It's right here, and we have the start of the news conference right here. So what happened? Well, people traders pushed the price up, but you can see they didn't push the price of an asset so much, and once again it got stuck in between these two trend lines. What had happened during the FOMC federal funds rates news? Well, price went up and down. What had happened there? Let's go back to the 5-minute chart. Okay, so people who entered long here and here when this high was taken, right, they got instantly liquidated before the FOMC. Then the FOMC happens, people enter shorts thinking price will go down now, and what does an asset do? It goes up to liquidate all of those late shorts and these shorts here. People buy here thinking, okay, we've got this high, next high is here, we will take it, and they got liquidated. Price went down again. People thought we're gonna break this trend line or this level, take these lows, they entered their shorts, price is going up. So an asset moves where the most liquidity is. That's what I see. Maybe I'm wrong, maybe I'm right, doesn't matter, it is what happened on the chart. So to me it is fairly surprising in a way, and it is, excuse my vocabulary, it is kind of magnificent how all of us look at the same chart and yet we see completely different and similar things. So what's gonna happen now? I don't have a clue, but what I know is that the price and asset will move towards where the most liquidity is, right? In my opinion, my current bias is that I'm gonna stay in this short. We will take these lows and we will go much lower eventually, but first, that's not gonna happen now. I would never enter a short position here or a long position. That's maybe the worst thing you can do. Why? Well, isn't it obvious? Look at this. Liquidate, 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 liquidate. So price is chopping up everyone, and when it chops out all the market participants here, it will move in the direction where it was supposed to move, right? I think that's down. Maybe someone thinks that's up. It doesn't matter. Once again, timing and place in the chart is what matters, right? I think it will go down, but do I think the price of an asset will go down like this? No. Maybe we can chop here for another 2 days, reach these levels, and then go down. Maybe we will go down right now to liquidate these lows, to chase them, maybe even these lows too. Then it can go up again to retest this trend line, maybe wick higher towards the levels, and then keep going down again. No one knows, and you should not care because you should be prepared for both scenarios. So what I hate and love about trading is that to me it's very interesting. It's maybe one of the most interesting things I've ever done in my life, no matter how stupid that may sound, but it is what it is. I would gladly stay more with you, but first, no one wants to listen to a guy talking about the same things all over again and again and again, so I am forced to leave you now. I said what I said. This is my personal view. This is not a financial advice. I'm not a certified financial advisor, and I might never be. Who knows? I don't need to be that to be able to navigate the markets, nor you too. So what will happen now? We will see. I've made 2 videos. I've said what I said. I have my current bias. My bias can change depending on the market and the levels. I will be very interested to see what's gonna happen next. If the thing that happens is the same that the thing I said will happen, I will make another video. I might brag about it a little bit because I am happy, and when I'm happy, I brag and I stand humbled if I'm wrong. If I'm wrong, I will make another video and I'll say, okay, I was wrong, but the point of all all of my videos now and in the future is to try and convince you that you can be wrong, you can be right. You will be wrong many times and you will be right many times. The point is to learn from your mistakes and to learn from your wins. Okay? To be better each day. To be better in assessing the data of the market, of analyzing the highs and lows, the indicators, the price action, whatever you use. Okay? So I repeat once again, people will tell you, oh, this is the best tool that I use. It tells you where the price will go. Fib channel is the best. Fib circles are the best. Don't use fib retracement. Trend lines are useless. RSI is useless. RSI is the best. So they are all wrong. Every tool is there for a purpose. Okay, every tool is there for a purpose. That's why it's called a tool. Okay, it's a tool. You can use that tool. If you know how to use that tool, you will be able to analyze the market sufficiently well, and you will be able to navigate the market with the least amount of risk and the biggest amount of reward. If you don't know how to use that tool, you will say, okay, that tool is useless, blah 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 blah. No, every tool is useful as long as you know how to use it. Let's say that fib retracement is a hammer, right? What is the purpose of the hammer? It is to hammer the nails into wood or something else, right? Well, if you use the hammer to break windows of a police car, or if you use the hammer to hurt someone and you end up getting jailed, of course you will say, oh, hammer is a bad tool. No, it's not about the tool. It's about who is using the tool, and it's about how you use those tools that you are given. So if you ask me, every tool is good enough if you know how to use it. If you don't know how to use it, well, learn. Sit down, warm up your chair, and learn. Learn, learn, learn. Get educated, learn from better traders, learn from the traders that are worse for you. Don't repeat their mistakes. Remove the bad habits, establish newer good habits, and do that every single day of your life. I know that some of you are busy. I'm busy too. I work on 2, 3 projects. I work out. I have a job too. I work because I want more money for investing and trading and marketing and everything. I understand that not all of us have the same amount of time to invest, but as I said before, I will say again, time is the biggest resource you have. Use it wisely to advance, to be wiser, to be smarter, to be more vigilant, and to be more pragmatic. Until next time, my dear people, I wish you well. I hope you haven't been wrecked in this choppy area here, and I'm really looking forward to seeing you in one of my next videos. If you have something to say, if you wanna share your opinion, I will take my time, and I will invest my time in reading your comments. I will try to respond to each one of them, at least to the ones that are worth responding. And what can I say? Have a good day, people. I'll see you in one of my next videos. Pragmatic loves you. Bye bye. Greetings, dear ladies and gentlemen. My name is Phil. I'm with Pragmatic Trading, and I'm so happy to be here with you today. Thank you for listening in advance. I have a short update. So last night, before, during, and after the FOMC meeting and press conference, I made a video in which I explained why I think people should trade the news in a specific way. I understand that everyone has their own trading style, everyone trades what they want, what they see, etc. But I firmly believe you should trade the news if you know how to do it. So I made 2 videos last night, and I promise I will make the 3rd video if the outcome is good or bad for me. So it seems like the outcome is good for me, so I'm making this short update. So when you watch this video, you will realize this is only the ending of one long video. I will merge these 3 videos and this video will be all about how you can trade the news. So as I said last night, this is my first video, so please bear with me, please bear with my awful accent, and once again welcome to another update. So I would like to start this video by showing you what did I say last night when I finished the second video. So I'll turn off this music. I hope it doesn't bother you. I really like blues and it helps me focus and stay awake while telling you important things. So I will play only a minute and a half of the video I made last night. Okay. And listen carefully, what did I have to say. At the moment of me saying this, the price, the Bitcoin was at 27.2. So let's listen. Give me a second, I need to turn up the volume. There we go, let's play it. It is kind of magnificent how all of us look at the same chart and yet we see completely different and similar things. So what's gonna happen now? I don't have a clue, but what I know is that the price and asset will move towards where the most liquidity is, right? In my opinion, my current bias is that I'm gonna stay in this short. We will take these lows and we will go much lower eventually. But first, that's not gonna happen now. I would never enter a short position here or a long position. That's maybe the worst thing you can do. Why? Well, isn't it obvious? Look at this. Liquidate, 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 liquidate. So price is chopping up everyone, and when it chops out all the market participants here, it will move in the direction where it was supposed to move, right? Alrighty, so that's everything. Let me just turn up the volume pretty quickly. There we go, let's play some music and let's continue with the update. So what did I say? I said that my bias remains to the downside because of the ever obvious reasons, and I said after the market chops out every market participant there is, it will move to the direction it was supposed to move, or to the direction it wanted to move. So a quick recap. In the beginning of this video, I've been talking about the Fed meeting, I've been talking about the small or lower time frames, and I've shown you what I see on the charts before, during, and after the FOMC. So FOMC was at 8 p.m. last night, right? It was right here. Market chopped out all the shorts and longs within this range. It went a bit above to liquidate all of these shorts, and it went below to liquidate all of these longs. Now, what did I say? You can rewind this video and see that I drew some random lines, which are not so random, where I said that after we take these lows, right? After we take these lows, we will go back up to retest this level as resistance and then continue down. And look what happened. That's exactly what happened, right? That's exactly what happened. Also, I told you that even if you don't have the perfect short or a long, like I was lucky to have here, you can always be pragmatic, you can be objective, and you can safely trade the news. I showed you last night, and you can see that in this video because it will be a long video. You can easily see how I showed you where can you find the confluence for the trade after the news. So the best short after the news was this one at around 27.3. We had some clear confluence there. I can show that to you again, but you have that in this video. You just need to rewind a little bit back. So why am I making this update? I'm not making this update to brag about how I figure out where Bitcoin will go, how did it go down, etc. I'm just making this video to confirm what I had to say last night. Okay, so let's go back to bigger time frames and let's see what's happening here. So I told you we have these trend lines, the daily and the 4-hour trend line, and what is important about them? It doesn't matter if it is a trend line or a pitchfork level or any other diagonal or horizontal level. what is important is that usually the first initial touch that you can see here with a big and important strong level usually produces a strong initial reaction. So sometimes, or I'd say very rarely, price can break out or break down from that level, but that does not happen very often. In most of the cases, price will not succeed in breaking that level. It will have a strong reaction, and then later on maybe it will break it, but that's a whole another story. Okay, so once again, why have I remained so confident in my short? Well, let's go back to the 1 hour and let's see what happened before we've reached these levels, 27.4, etc. Let's open the line chart because it's easier for you and me to visualize it, and let's focus on these bottoms. What do we see here? Low and a lower low, right? What do we see in the RSI? We see a low and a higher low. What is that? That's a regular bullish divergence. The time frame is 1 hour, so one would say, okay, it's 1 hour, it's not a strong time frame, it's not a high time frame. But what happened next? This little divergence produced a very big and a very strong move towards this 27.4. So if that was 1 hour regular bullish divergence, imagine what can a 4 hour regular bearish divergence, do in a downtrend. That's one of the main reasons. I say one off because I have more reasons and I'll talk about them. That's one of the reasons why I was so confident in my short and why I added to my position and opened a new one at the top of the week. Why? Well, I was very confident that there's a big possibility of the 4 hour bearish divergence being formed. At the time I did not know will it form. But of course, this is all a game of probabilities, right? No one never knows. So this is exactly why my short is still open. This is exactly why I was so confident about it. What's the second reason? Well, I've just talked about it. These trend lines, they haven't been touched for a very long time. This is the initial touch. And even if we go back to the daily chart, we see that an asset, Bitcoin, has struggled to close the daily candles above these trend lines. And what is happening now? We have the reaction. Do I have a crystal ball? Of course I don't. Am I the best trader, the best analyst out there? Of course not. I'm just here to show you what I see. I'm here to share my knowledge, and I really and truly hope you appreciate what I'm doing for you. And I'm just getting started, my friends. I'm just getting started. So let's take a look at other things. I almost forgot that I wanted to show this one. So besides all the tools that I use, and I use a lot of tools, I use anchored volume profile. Volume profile can give you a good feeling of a direction of an asset or its intention at the given moment. So give me a few seconds. I'll turn it on now. There we go. So if you have used this tool, you probably know that every volume profile has value area low. You can see this faded in profile here. It has a point of control, this red line, the place in the chart with the biggest volume, and it has the value area high. So let's see what had happened before the FOMC. In this video, you can rewind back, of course, if you want. I told you that the best place to long was before the news. Just like the best place to short was before the news, right? The safest, and I wouldn't say the best place was, of course, here, the 1 hour bullish divergence, but the safest place before the news to long was here. Why there? Well, we had a lot of things. First, we had a structural retest. What is a structure? Well, structure is when we refer to the candles, candle bodies and wicks, etc. So let's say this zone here was resistance, right? You can see these wicks, so an asset is hitting the supply, it can break out, and finally it breaks out. What happens when it breaks out? It has the initial touch with the trend line, it gets rejected, of course, and goes back to the same level Okay, I'll try to use my brush to try and help you visualize it. So that was resistance, and now ideally that should turn into a support. Did it turn into support? Yes. What do we have besides this rectangle and this structural level? Well, we have the value area high of this whole range. When I say this whole range, I mean this range that started here, right? This is the volume profile of this whole range that starts here. So this is a typical retest. This is a typical retest to confirm this previous resistance as support. And that's exactly what happened, right? That's exactly what happened, and that was the best place to long. Now, what is happening now, right now? Well, isn't it beautiful that this 4-hour candle closed exactly at the value area high of the whole range? I mean, I don't believe in coincidences, and I think this happened on purpose because many traders agreed that the price should close. When I say agreed, of course, they didn't have a discussion, they didn't have a meeting. When I say agreed, I mean that everyone was trading at that moment and the market agreed that the 4-hour should close there. And what happened next? Well, no wonder the price kept dumping. So, to me, this is all interesting. Now, I think this video is too long already. It's focused on FOMC, etc. I have already talked in this video about my full take profits target. I will say that many different people trade differently. Maybe someone is in a losing streak, maybe someone is in a winning streak, someone likes to secure profits by putting the stop loss at break even, someone likes to secure profits by lowering or putting it higher if it is a long, their stop loss in the profit zone, etc. And someone likes to wait for the full take profits and take profits in between just in case. So I won't make this video any longer, it's already too long, it's probably 1 hour and maybe 20-30 minutes, but in my opinion it's a very useful video because I've gone through all of the details to show you how you can trade the news. Now, as an addition, to make this video more valuable to you or to people that you share this video with, I will do a quick, not so detailed analysis of what could happen next. Okay, so let's do a simple fib retracement and let's see what can we find here. Alrighty, so what's interesting to me is that this fib level here, around 25.64, could be very interesting. Why? Because, well, value area low is almost at the same place where this fib level is. Of course, these yellow and orange lines, they are the golden pocket, everyone knows that, but this fib level below is also equally, if not more important, in my opinion. I don't have to be right, okay, everyone has their own analysis, I'm just showing you what I see and what I think. So, if you are in a short, you should be careful with this level, because even though this dump is pretty strong now, even though it shows a lot of strength, all of these longs are being liquidated as we speak, this could be a good level to long and maybe retest the trend line, and then we'll see, maybe we will keep going lower, etc. But I don't wanna go so far into the future. So that's what I see when I look at the chart. It makes sense too, because it's the value area low, and you can see that all of this action here, these wicks, are in the same zone, right? So ideally that should be the support for people who think price will go up. What can I tell you guys? My risk to reward in this short is pretty big. I moved my stop loss, it was even tighter. Okay, so once again, I know this is a spot pair, you can't short spot pairs. I'm using this because I'm charting on Coinbase and other exchanges, and I'm using this to visually present where my trade is on other exchanges. So that's all, guys, that's all. I'm not sure what else can I show you. I can show you one more interesting thing. Sorry for the noise, it seems like my phone is ringing, but who cares? I'm busy right now and I will not answer my phone. I'll stay focused. I will not answer my call, I'm sorry. So give me a second, I need to find the pitchforks. Yeah. So what is interesting about these pitchforks? This is a log chart. Let's switch to non-log chart. Okay. What is interesting about it? Well, I will hide this fib retracement for now. Do you see these yellow and orange lines and the green lines? So this is the golden pocket of this macro pitchfork that I showed you earlier in this video, right? And you can see that this golden pocket and the level below 7706 produced a strong upwards move, right? Now that move is fairly over, I can say. What is interesting about it? Well, when the price goes back, let's go back to the 4-hour chart. When an asset, when Bitcoin goes back to that level, and if it goes back to that level, you will realize that we have 3 strong confluence points at this point. We have the value area low of the whole level, of the whole range, I'm sorry. We have this fib level here, and it's at the same place where the golden pocket of that pitchfork is, 618, 65, 66%. So I would expect something like this, okay? If the price keeps dipping, I don't know how, maybe it will go up and down and up, it doesn't matter. If and when we reach this level, I would expect another strong bounce upwards. If and when that happens, it will only be a bearish retest until proven otherwise. Of course, as a trader, as an investor, as an analyst, you have to be pragmatic and objective, and you have to realize price can go either way at every given moment. So what can we say? Well, it's pretty easy, right? If and when price reaches this diagonal and horizontal level, it would be a good place to try and long, in my opinion. Okay, it's definitely worth a risk. I can and I will find more confluence if there is more confluence there. Okay, and it would be a good place to hedge your short, to have another position open in case price reclaims these trend lines and goes up. Then you wouldn't care, you would secure some profits from your short, you would be in a long, and the price can easily continue up with your long in it. So ladies, my dear gentlemen, I hope I was helpful. Okay, I hope I was helpful. If you find value in my videos, please consider liking the video, sharing the video with your friends or the people that you know, or simply sharing the video on the platform you use, because I firmly believe many people can find this useful. That's it. I hope I didn't take much of your time. Pragmatic Trading loves you. I hope you will be successful in the market, and I hope my videos are useful for you. I hope you find some value in my videos. So I'll see you next time. This video will be probably published on Sunday or Monday. I'm sorry for that. My video editing guy is not here currently. He's on vacation, and I respect the time of other people. So stay well, and I'll see you next time. Bye bye.